G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, I'm going to be giving you guys 3 different stock valuation methods for meta platforms, and we're going to go through each of them one by one. So the first one is going to be a quick back of the napkin style owner's earnings valuation. We're also going to be doing a sum of the parts valuation where I break down each of Meta's business segments and we value each of them one by one. And then I'll be finishing it off with the classic discounted free cash flow valuation method. But guys, before I get into it, make sure you like this video and subscribe to my channel. So we can see Meta's stock price here. They're currently trading at $155.85, and the stock is down almost 54% year to date. So it's absolutely been raked through the coals, completely beaten down. So let's have a look and see what kind of returns we can expect from Meta stock. So first up is our back of the napkin owner's earnings style valuation. And when I do these valuations, I really want to establish a basic relationship between what we are paying versus what we are getting. Because at the end of the day, that is fundamental basic value investing. You want to pay less than what something is worth, and you want to buy good, fundamentally strong assets as well. So what are we paying? Well, currently Facebook is trading at $422 billion as their market cap. So that's what we can pay to purchase the whole business. And then we got to look at what are we getting. And currently we're getting $43 billion in cash and cash equivalents with no debt. So this is their balance sheet. So if we minus the cash and cash equivalents from the market cap, that gives us an enterprise value, or EV as you see here, of $379 billion. So then I got this next number here from the cash flow statement. This is from the 2021 cash flow statement. And in 2021, they had cash flow from operations of $57.6 billion. And they had a capex spend of $18.5 billion. And when calculating owner's earnings, you only want to subtract the capex for maintenance from the cash flow from operations in order to get owner's earnings. You don't want to minus away the capital expenditure which was used for growth. And for Facebook, I think a reasonable assumption is about 50% of capex is for maintenance. Of course, they're spending heavy into the metaverse and developing their VR and AR products. So a lot of their capex is actually probably growth. However, we want to be conservative here, and who knows if we ever get a return for the metaverse capex. But if we go and run the formula here, so we got our cash flow from operations minus our capex, and we times it by 50% because that's the ratio that we want, and that's the ratio we're using, and we get an owner's earnings of $48.35 billion. And then if we take the enterprise value and divide it by the owner's earnings, we get a backward looking EV to owner's earnings ratio of 7.84, which is really quite bizarrely cheap for a company such as Meta. Whether you love them or hate them, there's no denying that they're a cash flow machine. Just pull up the income statement and look at their margins. Just look at their revenue growth over time. Yeah, it's slowing down. However, if you think this business is even going to grow slowly for this kind of multiple, you're probably going to make a satisfactory return. So now let's jump over and have a look at the sum of the parts valuation. This one's a bit more in depth, so let's go check it out. So now if we check out the sum of the parts valuation for Meta stock, I've broken the business down into 5 different segments here. The first segment being net cash, the second one being WhatsApp, the third being Facebook Messenger, the fifth being Reality Labs, and the sixth being Instagram and Facebook. So pretty much I got a net cash value per share of $16, and how I got that was I got the net cash of just under 44 billion, and I divided it by the current shares outstanding, and that gets us $16 per share of value. And then in the next segment here, which is WhatsApp, we get a value per share of about $15. And how I got that was I took the February of 2014 purchase price that Facebook bought WhatsApp at, and they paid $19 billion for WhatsApp back in 2014. And back then they had 465 million users, and currently today they have about 2 billion users, and that's pretty much a 4x from 2014. So if we take their 2014 purchase price of 19 billion and times it by 4, pretty much we get a value per share of about $30. And just for the sake of being conservative, I divided this by 2, as obviously this is a very sort of dubious way of valuing a business, and we don't have too much information on sort of how to value WhatsApp, as it currently isn't monetized to its optimal standard, or is barely monetized at all, I should say. And the same kind of goes with Messenger, and Messenger's got about 1 billion users on its platform, and I've just used half of the value of WhatsApp, as WhatsApp has about double the users of Messenger. So if we move on to Reality Labs, I've valued this part of the business as negative 30 billion, or not 30 billion, sorry, negative $30 per share in value. And how I got this was, this year they're going to be spending about $12 billion on CapEx for Reality Labs, and I think over the next 5 years, on average, they'll probably spend about $16 billion per year on CapEx for Reality Labs. And if we take that average of $16 billion over the next 5 years, that gives us a cash burn of about $30 per share in value. And now for the big one, this is the part that matters the most. It's Instagram and Facebook. So last year, Facebook and Instagram had operating income of just under $57 billion. And I've pretty much used a 15 multiple here on their operating income, and that gives us a per share value for Instagram and Facebook of $311.52. And then if we sum all these numbers up, we get a total value of just under $320 per share. And currently we're trading at $155.85. And if we just grow this value per share out by 8% over the next 5 years, we're looking at a 2026 share price of $469 per share. And this represents a CAGR of 25% per year. Now, some of you might find some of these assumptions unreasonable. Maybe you think WhatsApp should be valued at 0 and Messenger should be valued at 0. Even if we do that, you're still looking at a 23% CAGR. Maybe you think the 5-year growth rate is too high. Maybe you think they're only going to grow at 3%. Well, you're still looking at a 17% CAGR. And of course, this valuation here isn't even factoring in any cash that they're going to be doing on or allocating to share buybacks. So you got to keep that in mind as well. So that makes this even more conservative potentially. Or maybe you think that, this 15 multiple is too high and you think 10 is more reasonable. Well, then you're looking at about a 8% return per year if you believe that to be the case. But if we actually look at analyst estimates, you can actually see that analysts are expecting revenue growth of, if we don't count last year, so let's just move this forward 1 year. They're expecting revenue growth of about 13.1% per year. So if we just go with these analyst estimates here, 13.1%, well, then you're looking at a CAGR of 29%. So, I mean, it feels pretty high, but look, guys, I've provided you with a few different options here so you guys can make your own decision. So the final valuation method here is the discounted cash flow, and I've taken the owner's earnings from last year and then I've projected owner's earnings going out through to 2026. I'm using growth rates of between 4 and 12% here, and pretty much I've manually entered a 2022 owner's earnings of 42 billion. How I got this was I used analyst estimates. So analysts are projecting for 2022 to have cash from operations of 57 billion and a capital expenditure of 29 billion. And we're going to assume half of it is for growth, half of it is for maintenance. And that's how we get our $42 billion in owner's earnings. And then I've done the same for 2023 as well. So I've taken their 65 billion projected cash from operations and minus half of their capital expenditures from that value, and that lands us at 48 billion. And then from there, I've multiplied the owner's earnings by our growth rate. And if we use a terminal multiple of 15, which feels fairly conservative for Meta, we use our required rate of return of 22%, current shares outstanding, and then if we factor in net cash, this gives us buy prices of between $155 all the way up to $182 for a 22% return, depending on what growth rate you use. It's up to you guys to decide what parameters you feel comfortable using, but for me, I feel fairly comfortable with these numbers here. So guys, I've provided you 3 different valuation methods. I hope this video kind of provides a guide on how you should think about valuing Meta stock. Obviously, there's a lot of things that could change the valuation, and going into economic uncertainty, it's always good to be conservative with your models. But guys, I hope you enjoyed this video. Smash the like button, and I'll see you in the next one.